Welcome back to our Financing Simplified podcast, brought to you by In Touch Mortgage Solutions. Once again, my name is Anthony Venuto. I'm your host, and joining me today is Claudio Venuto, our mortgage broker, underwriter / everything here at In Touch Mortgage Solutions. And I'm glad to have him back on to talk a little bit more about some of the current topics right now, such as what's happening with inflation and all those numbers coming down. We're going to talk a little bit about debt consolidation and refinancing. Claudio, let's jump into the hot topic right now. Inflation came down from 4.4% down to 3.4%. That's a big drop. What do you think is going to happen with, what are your thoughts on the Bank of Canada here right now?
Well, right now, I think by them increasing in June, right, the quarter point, I think they're going to hold steady and most likely flex and do it again just because they've seen that inflation dropped. And I think they're going to exercise their right to do so because at the end of the day, they have to watch out for Canadians and they want to try to control the market.
I think it's a pretty spot on assessment. I think with the Bank of Canada right now raising quarter point in June, I think they're poised to do another quarter point at least in July. And the reason behind that, as we've talked about off camera, is sort of, just thinking about the Bank of Canada trying to ensure that they have the base of their, understanding in the sense of consumer confidence, consumer expectations. What they really want to do is just make sure that they have a firm grasp on inflation and they don't want to let it go. They don't want to see what happened back in the Volcker era many, many, many moons ago, back in the late 70s, early 80s. And with the Bank of Canada paying very close attention to consumer debt, they're also seeing the home price index, sort of those average prices tick back up. They're going to flex. They're going to definitely bump up that policy rate, that overnight lending rate, at least another 0.25%. I would be hard pressed, as I said, if I had to bet. I think that they, as I said, the worst case scenario, they're going to raise, maybe they're going to pause. But this is something that's really interesting with the Bank of Canada. This is like the first time I believe in history, or at least since I've been a mortgage broker, that we've seen the Bank of Canada raise, and then hit the pause button and then raise again. Usually after their pause, it's usually a decrease. So that's something that's really interesting.
Yeah, it's really crazy because, right, when I think we're at a 22-year low now for inflation, right? We haven't seen it at 3.4% for a long time. And I think they're backtracking because now they've seen what happened when they paused. Canadians are resilient. They want to be homeowners. And as soon as they seen that little bit of consistency, what happened? House prices ticked back up. People came back to the market. They kind of got used to the rates. And I think that's going to be the biggest indicators that Canadians are just going to be like, okay, if these are the rates, this is what we have to get used to. I'm not going to lose out on a home. I'm going to do whatever I can to qualify. And, us as mortgage brokers, we're seeing it. They're going to do whatever it takes. We see this and we go, what's happening out there? We hear it on, talking off the mic. There's a lot of fraud happening too. And I think that's one thing the Bank of Canada, in my perspective, has to worry about is that if they push too much, people might start committing fraud, and going to illegitimate ways to find mortgage financing to get them into the house that they want to be in.
No, you touched on it right. This is the lowest inflation has been since, I think 2021, July, where we were really, really high. And you're right, the Bank of Canada is paying close attention to everything that's happening. They sort of created this problem. Obviously the Bank of Canada has been under the gun. My thoughts on the Bank of Canada was they misrepresented the transitory inflation numbers. Obviously coming out back in during the 2020s, saying that we're going to keep interest rates low. So now they need to sort of rebuild that confidence. And when it comes to Canadians who want to buy a house, this is ultimately you're battling between the Bank of Canada, what the Bank of Canada is going to do, and what's happening in the housing market. And just for clarity, a lot of our viewers, a lot of clients that may be tuning in, we still get this question all the time. It's like, when we say, rates have gone up, fixed rates have gone up, and then they're like, but I thought the Bank of Canada is not meeting for another month or so on. So there's a difference between those two components, what's happening with the monetary policy rate, the overnight lending rate, and what's happening with fixed rate mortgages that are driven by the bond prices. But I think you're right. It's like gas prices. People, will complain. They'll get used to it, but they're not going to stop driving. What they're going to do is they're going to change their vehicles. Maybe they go with something a little bit more fuel efficient. And same thing in the housing market. People are going to, instead of buying that detached house, well, now I'm going to go buy a semi or a town or a condo because that's more affordable. They're going to bend. They're going to change their dynamics on what they want to buy. And I think that's what we're seeing happening right now, where we're talking to people. Yeah, they had these expectations of buying this home, but now, prices, interest rates, affordability has come down, and they're not able to qualify. So they're just changing direction. They're not necessarily those who can qualify, those who want to buy, they're going to buy.
Yeah.
As we always say, marry the price, date the rate. If you get into a house, like if you would have bought in November or December of 2022, home prices have steadily gone up since then. And, even if you saved $100,000, $110,000, $120,000, if you would have bought even with a higher interest rate, you're not going to see that translate into savings. Even if you're paying a little bit more in interest, the fact that you saved 100 to 150, maybe more, depending on the geographical location of where you're buying, you're not going to see that savings in the interest rate.
Yeah, I think they go hand in hand because, we've seen with people's mortgage rates and their interest rates rise, they've done whatever they can to maintain their mortgage payment. They're going to, with credit cards, you have that option. You can pay the minimum payment and they can divert that money back into their mortgage, right? So either they're putting down more towards their principal, or they're just alleviating their credit cards. They're seeing a lot of debt build up because of that. So now, they've kind of pushed their credit cards off to the side, and they've seen their balances rise, but their mortgages are intact, right? Mm-hmm. They're not going to fall behind on their mortgage payments. So now is a time where we're going to be seeing a lot of high credit card utilization, a lot of high debt, and people's credits being impacted by that. So it could be a time to refinance and consolidate their debt under their mortgage into one product.
To talk about debt consolidation, it's very critical to understand what kind of debt you're consolidating. Is it good debt versus what's so-called bad debt? Debt is debt, but there is, I believe, a hierarchy in the debt servicing. Obviously, credit cards being, these payday loans, these type of very predatory lending types of products that are available to Canadians here that thankfully are starting to get a little bit more attention and are actually being governed under Budget 2023. But to your point where we were talking about, debt, a lot of Canadians are resilient when it comes to paying their mortgages. Historically, default rates in the mortgage space have been sub 1%. Even during the GFC, the Great Financial Crisis, 08, 07, 08, 09, we saw a lot of Canadians basically come out unscathed. But now as interest rates start to change, Canadians are going to lean on whatever debt they or whatever credit facilities they have in order to make their mortgage payment. If that means, that they're going to put those credit cards to the wayside and sort of leverage those, we're starting to see that, right? This is statistically proven. I believe the Nanos poll came out with some data saying, insolvencies are up, bankruptcies or credit consumer proposals are up right across the board. But the highest cohort is in the millennial generation. Right. And I think when we talk about debt refinancing, good debt, bad debt, I think there is a big gap in the financial literacy component of understanding how things work. Myself and my brother, obviously understanding that we came from a financing household, our families were involved in financing. So these were conversations that we have. We understood credit. We understood the importance of maintaining good credit. But a lot of people out there may not fully understand that. There's not a lot of outlets for them to actually understand this. And by the time they get to this point, right, by the time they've already racked up their credit cards, if they're blessed enough to have a home that they purchased eons ago or years ago, and there's a lot of equity built into that home, you have to take into consideration, yes, interest rates are high. You may have to, forego that lower rate of interest. But when you start to add in and think about, I'm paying 22% on this credit card. I'm paying 9% on that credit card or line of credit. I'm paying this amount of money on that particular mortgage. When you take all that into consideration and you sort of say, how much is coming in, how much is going out? And if I can alleviate a lot of that pressure by refinancing the debt that I have into one simplified payment, it gives a lot of people that confidence. Okay, so with debt consolidation, there's a lot of content about home equity lines of credits and so on and so forth. It's obviously a good strategy because you may not have to refinance your mortgage potentially to get a line of credit. You can talk to a mortgage professional, see if there's an option for you to get a line of credit. But it's one step up from the mortgage, right? So you have like your mortgage, which is obviously in general terms your most inexpensive way to consolidate debt, in my opinion. Then you have your line of credit, which means you can leave your mortgage pretty much intact, add this line of credit, but generally right now with prime being 6.95%, most lines of credits, if you're secured, what are they?
Yeah, you're looking at plus 0.50 basis points on the rate, so you're around 7.5, almost 8%
On a secured.
on a secured line of credit, right? Where unsecured, you're closer to almost 10, 11%.
Right. And then you have your credit cards, which are generally anywhere north of that,
19 or 21.
19 to 20%.
Yeah.
And yes, there's those promos, transfer the balance for 6 months, but it's paying attention to what that ends up being and what's the strategy. I always tell clients, like, if you're planning to not refinance your mortgage because you don't want to lose the rate, I get it, I understand. But you have to look at what's your game plan to pay off that exorbitant amount of credit card debt. If you have 40, 50K in credit card debt and your income is only X amount and your mortgage is X amount, how do you plan to pay that off? A lot of people just pay their minimum payment, but not understanding what it's doing to their credit, right? If it goes over a limit, even once it goes to that capacity, your credit score is getting it's getting sideswiped.
Yeah.
So everyone's afraid now. What can you tell them? What can you guys tell them on how to get to the solution to this issue that they have?
The best way is definitely, it is case by case, because everyone's situation is different. I think that's how you have to approach it. Just to come out and say that there's one solution that will fit everybody, I'd be lying to you. And it's just sitting down, understanding. Like we tell our clients, like, what's your monthly budget? Do you know what you're paying? Like, do you know what you're spending, what's coming in, what's coming out? And for some, it might be as easy as, you have 2 or 3 credit cards. Let's maybe just get an unsecured line of credit. We'll minimize that interest rate of 20%, 21.99% under an 8% unsecured line of credit just for the time being, if you don't want to touch your mortgage, right? But then it might be the fact that we might have to break your mortgage in order to consolidate everything. But like I said, it's case by case, and we're here to help guide you, right? There's not one universal answer that I can give to everybody.
To add to that, I think it's really important for people to understand that by going through these bankruptcy credit proposals, it's critical that they understand, because a lot of times we're talking to these clients after they've undergone these services, and they were never advised of how to get themselves reestablished. It's just the trustee will just do the work, the bankruptcy trustee or whoever's responsible for dealing with that part, with that product, and then it's like you're on your own, right? And then it's like the 2-2-2 rule, like 2 years reestablished, 2 new trade lines, basically, for 2 existing years, right? So like there's that whole process that gets involved in reestablishing. But when you look online and you hear these ads, and I think that's sort of what we hear happening right now, is all these commercials for home equity lines and lending, and they advertise the rate and obviously the product itself. It's so interesting because they offer the same products that we have access to as professionals, but at a different sort of perspective. Like we have a lot of clients that have, like, I don't want to say the name, but we'll call them and then we'll be sitting there listening to their conversation and talking to them about their private mortgage or the line of credit that they got. And you're sitting there saying, oh my Lord, like this is incredible how much interest you're actually paying. Like, did they actually do you a favor? Was there anything done here that actually helped you? It was just when the client needs money, they are almost like tunnel vision, right? Yeah. They don't see what's coming from the other angles. And it's just absolutely atrocious what's happening out there. And as I said, if you own a home and you're thinking about going through a consumer proposal, bankruptcy, you have questions, reach out to a mortgage professional. See if there's something. It doesn't hurt to get that second opinion or third opinion to see exactly where you stand. To find out more about us, you can definitely follow us on social media at @A_Venuto. You can follow us on our social media, our YouTube, as well as making sure that you like and subscribe if you like the content. But more importantly, you can always send us an email. You can follow us in the description box below. All our contact details are there. And thanks for watching. Thanks for clicking, and we'll see you next week.